Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, again, talking to you about structure. I'm trying to get a lot in for you this morning because I know just from people I'm talking to as they're coming in, new clients coming into the office, a big concern has been the markets and what's going to happen. Not so much, I mean, most people I talk to recognize the cyclical nature of the market, that we're going to have bear markets, we're going to have bull markets. Typically, it's about, I think, once every 10 years we might see a bear market. You're going to have those statistically, I think it's 1 in 6 years where you might see a correction that approaches bear market territory, around 20%. And of course, 10% corrections we see almost every year. So you see those, but when you look at the end of the year, over the calendar year, more times than not, it's positive years. And I think it's statistically, again, about 1 in 4 years are negative years. Now that doesn't mean that you're going to say, oh, we had a negative year, now I'm going to have 3 good years. It statistically means you could have 1 bad year and you could have 8 good years, and you could have 3 bad years and you could have 4 good years. So what you want to think in terms of is more the fact that when I talk to you about 1 in 4 being negative, is just to understand 3 and 4 are positive. And that's why investing in the market is one of the best ways and one of the most proven ways to stay ahead of inflation and taxes. But how to invest in how the smart money invests in the market is another thing entirely. And this is where different strategies can help. I mentioned again, this might be a time to look at blending some annuities in with in particular with the market where it is right now, adding some fixed index annuities, uncapped ones. Now that doesn't mean all fixed index annuities are the same or created equal, so to speak. There are some that have very high fees, low participation rates, caps, things that are going to limit how much you can earn on them and maybe not be such a good deal. But when you're looking at uncapped, low to zero fee, high participation rates, there are products like that out there. We do a lot of research, in fact, to find the best ones, and through that be able to bring those to you. So again, if you'd like to find out more about it, you can call my office. We're going to talk a little more on the show. I'm going to, in fact, in the next couple of weeks, I'll probably bring in more about some of the latest innovations with regard to index annuities and how that can be a benefit to you. We're seeing really good returns with those, and again, safety is one of the other factors where they're set up to protect your principal, where you're going to get a principal guarantee, in fact, where you don't have to worry about the downside so much. And they can really, again, help you. Jeremy, and I don't know, do you do much with your clients when it comes to different types of annuities? And you know, fixed index annuities is one of my favorites, of course. But right now with fixed annuities, as I was talking about before the break, inflation may be going up right now, or maybe we're hitting a peak in it. But the key is it is temporary. If I can get in a 5-year or longer guarantee for, in particular, if we get up around 6% and lock that in, now when the numbers start coming back down again, I'm going to be really positioned well.
Yeah, absolutely. So I love fixed index annuities, and I use that for my clients all the time. It's really, really good as what I call a bond proxy, because fixed index annuities, especially annuities that are accumulation oriented, have really outperformed bonds over the last, gosh, Hank, 10 years now, because historically interest rates have been so low. Now, the great thing about fixed index annuities, if the market is negative for the year, annuities have a 0% floor. So you might have heard that term, zero is your hero. You're not locking in any losses. You're not having any losses. So overall, looking at a fixed index annuity as a portion of your overall portfolio is really doing well this year, given that the market's down 20%. So we love them. We utilize them very heavily at my firm.
This is one of the areas, again, we're going to see that with fixed index annuities, and there are some hybrids coming out right now. This is one of the things I love about when you see the types of volatility, the types of upheaval, the types of changes that go on in the marketplace. The innovation that a lot of times will come out of that can be very, very beneficial. One of those, and that's where we've seen, for instance, with fixed index annuities over the last, I think it's been almost 30 years now that the first fixed index annuity hit the marketplace, and how much they've evolved from just the one S&P 500 index to using multiple indices, and now even more creative indices that are being created by some of the major banks like Citibank and Barclays, and Bank of America, among others. All of this means better products for you, the consumer, right? For us out there that are looking for ways to help improve our overall investments, our overall financial plan, this can be a real benefit. One of those is a hybrid, okay? We're starting to see this is one of the more recent innovations. There's a company right now, I believe, that's offering even I think it's 4.75% fixed account amongst other index accounts. So basically you can have both a fixed account in with the index accounts. The index account's tied to the market, the fixed account with a minimum guarantee. So it's a great way to, again, enhance your overall planning. You know, Jeremy, one of the things we've been talking a little bit about the stop loss, and I want to come back to that. In fact, yeah, this is an area I wanted to talk a little bit about as well for clients to understand, is that of the market weight index. So when we talk about the S&P 500 index, this of course is the 500 largest companies in the United States. They make up about, let's see, 70% of the money in the stock market, outperforms over 90% of mutual funds out there. So the S&P 500 index can be a great investment tool just in and of itself. However, we might look at another enhancement to that. We have the market weight of the S&P 500 index versus what we now have as an equal weight index. And this is relatively new, I think, as far as in particular for investors, and not that available. I mean, I haven't seen an equal weight index, for instance, through Vanguard or Fidelity or any of the other large firms that we might see that from. So why don't you talk a little bit about the difference between market weight and equal weight and how that works?
Sure, Hank. If you look at the market weight index, when most people think of the S&P 500 and the top 500 largest companies in the United States, a lot of people think that each company has its own weighting, or a 1/500th weighting, and that's actually not true. Hank, you got some really good slides here. For example, the top 25 companies comprise of 41% of the total value of the S&P 500. And actually, the top 5 companies comprised of almost 20%. So when you think about that, if you have growth companies, for example, like Amazon or Microsoft, who actually just had earnings last night, and they were pretty rough, and I saw Amazon pre-market down 14%. That's a really, really large down opening. Mm-hmm. That's going to contribute to the S&P 500 moving up or down in a much more volatile way than an equal weight index. Now, an equal weight index is exactly what it sounds like. Each of the top 500s has a 1/500th weighting. So you're not overweighted in technologies or financials or things of that nature when one sector is very volatile, like growth right now. We saw growth started to sell off of November last year. The NASDAQ, you said, Hank, was down over 30%. So a lot of growth companies in that wouldn't be affecting the equal weight nearly as much, and the equal weight does so much better in terms of performance in very volatile markets, and historically equal weight has outperformed the market weight.
Well, and to your point, this is one of those areas when we get into equal weight outperforming. Over the last 20 years, equal weight has outperformed market weight. Now, there are periods of time where that could, you know, where market weight, of course, will outperform equal weight, but it's less of those times than the equal weight will outperform. And the other piece that goes with that, what Jeremy was just saying, is just the top 25 companies in the S&P 500 index make up about 40% 90% of what drives performance and risk and volatility. By the same token, when you look at those top 25 companies, you find most of them are either tech or telecommunications. So here again, you're narrowed down not only in terms of the amount of companies, but in the sectors that those companies represent. And this is another area when you get into market weight versus equal weight, is that of the sectors and what and how they get more overly weighted with a market weight. And this again just creates more volatility. So Jeremy, you can talk a little bit about the sector piece. And this is one of those, sometimes we talk about the markets as far as market cap, large companies, small companies, for example. But another way to look at the market is that of the sectors, that is financials or healthcare, consumer staples, consumer discretionary, those kind of things. So how this works is the same, right? With the market weight, you're going to be more heavily concentrated in one or two sectors versus an equal weight, which is again going to do just as you said, more evenly divided.
Yeah, that's correct, Hank. So like I said earlier in the presentation, is that being in the right sectors and asset classes this year has really been your friend in terms of performance. If you were overweighted in something like growth, for example, you're not doing so well this year. In fact, you're actually down more than the S&P 500 by a good margin. So being in something like the equal weight that distributes more of the weighting into various sectors, think of it in terms of better allocation or better asset allocation. That's going to reduce your risk long term instead of being overweighted in one sector or not. What we don't want to see is something called sector weighting, where you're too high and too low in the other one. And the thing is, Hank, a sector, can't always be the best sector. So if you're underweight in a sector and it really starts to do well, like healthcare or consumer staples, what have you, you're going to miss out on some upside. So there's definitely a pro and con to it. Yep,
this is one of those areas. We're going to take a break. When we come back, we'll talk a little bit more about that, because this is one of the areas, understanding a little bit about these different, whether you're talking market cap or whether we're talking sectors, how that might play in, how different strategies using those can help play into improving your overall investment portfolio. All right, first a break. Join us here. We'll be right back on the Retirement Report.